Hi there, welcome to Kneppy Invest. When I first started investing way back in 2009, 2010, something back then, I was all about trying to find companies that looked really good value, had a nice margin of safety, and I was comfortable owning the companies for the long term. And one of the reasons I started investing then, and I was just fortunate timing because I just entered I suppose, the workforce on a permanent basis back in 2008. We just had the GFC, and in 2009, we're coming out of the GFC, and the stock market was not going to go much lower than that. And everyone was telling me, why are you going to put money into the stock market? It's a fool's game. You're going to lose all your money. And because I was being told that time and time again, that was, in my opinion, the ideal time to move into the stock market. Now, back then, it was all about finding value plays, finding companies that looked pretty cheap. And most of the investments I made back then were quite successful. For instance, Commonwealth Bank, BHP did fairly well during a period of time. But these days, I'm finding it much harder to find value plays. In fact, many of the value plays are pretty crappy, low quality companies. But on occasion, I will come across a scenario of a company that looks really, really cheap. And possibly I found that with a company called PeopleIN. Now, I wouldn't classify PeopleIN as a high quality company, but it does have some characteristics of being possible high quality company. I'll talk about that in a moment or two. But the problem with these possible value plays is a scenario where instead of it being a value or good value, it's a value trap. The share price and the valuation of this company has dropped significantly for a reason. And I'll touch upon some of those reasons towards the end of the video. So in this particular video, I'm going to have a quick look at PeopleIN, trying to decide whether this company is good value or even really cheap right now on the 12th of December 2023, or it's a value trap. Now, for full disclosure purposes, I've already done a fair bit of research on this. I have actually taken a position in this company on the 11th of December, and the main reason was just a trading position because the share price had fallen a fair bit. It looked like the shares had been oversold, and I do expect a bounce. Now, there is a possibility that if the share price has reached low and we start to see a bounce, the share price could rally for a fair bit because all the worst case scenarios have already been priced in. And if the company releases any positive news, the share price could rally a fair bit. In fact, there's a possibility, a scenario where the share price of this company rallies 100 to 200, even 300% over the next few years. Now, before I look at why I might consider this company a value play, a cheap company, or possibly even a value trap, what does this company do? Now, this is a recruitment company. That's how I define PeopleIN, but they call themselves a talent solution company. They have 25 brands in healthcare, IT, finance, and business, mining, manufacturing, construction, government. And some of the services the company provides include workforce management, recruiting, onboarding, contracting, rostering, timesheet management, payroll, and workplace health and safety management. Now, over the past 5 years, this company listed on the ASX 2017 or 18, quite impressive growth. When you look at revenue, earnings, and free cash flow, the company has been making some acquisitions. So not all the growth in revenue has been organic, but I look at revenue, earnings, and free cash flow per share growth, and very impressive growth. And if they can maintain that growth moving forward, even though the company is experiencing some headwinds right now, this company does look cheap. And I'll touch upon their financial information and also look at some of the valuation metrics and also look at those growth metrics I just touched upon during the next 3 slides. So let's have a look at their financial year 23 financial results. $1.2 billion of revenue, up from $679 million in financial year 22. Now, this company is quite acquisitive, so they have made quite a few acquisitions. As I mentioned before, they have 25 brands, and they keep adding to those brands with acquisitions, but they still had 25.6% organic growth in revenue. So there is organic growth in that growth in revenue. Profit of $19.1 million, only up $1.5 million from last year, which was $17.6 million. So if you compare the revenue to profit, you can see this company exists on pretty low margins, which is understandable because a lot of that revenue is, in fact, the majority of that revenue is contracting. I think about 95% of the revenue is through contracting. A return on equity, 11.9. In fact, this company, through its history, has had a return on equity above 12. In fact, the median is around 17. But if you just look at the last half year results, the return on equity has dropped below 10. And that is telling us this company is facing some pressures, particularly on margins. Free cash flow of $55 million in financial year 23. And just have a look at that markup, $100.6 million. So compare the profit, the free cash flow, to that market cap. Now, this company does have a little bit of debt, which I'll touch upon in the next slide, but they also have a dividend, and at the current valuation and share price, the dividend yield is 14%. So don't go running off and buying shares in PeopleIN, because the market is saying that the profit, or they expect the profit to drop in financial year 24. They expect the dividend to drop significantly. So I wouldn't expect a dividend yield of 14% in this current financial year. In fact, even if profit drops by half and they drop the dividend by half, you'll still get a dividend yield of 7%. So a pretty nice dividend if the profit drops by half. But there is a scenario out there where the profit drops by even more than half. There's also a scenario out there where profit actually becomes negative. So this company is loss-making in financial year 24. Now, one of the surprising things I found when I started my research on PeopleIN was a 5-year CAGR in revenue, earnings, and free cash flow. And this is on a per-share basis. So this is the qualities you usually find with a high-quality company. So revenue, 20% per year, earnings at 10.4% per year, and the difference between revenue and earnings growth is an indication on pressure of margins. So margins have been dropping over the past 5 years. Free cash flow at 20.5% per year. So nice, really good growth in free cash flow. But look at the return. So over the past 5 years, if you held this company, you've seen a negative 10% return. So that includes share price depreciation, and the share price has fallen a fair bit, plus dividends. So there is a bit of a disconnection between revenue, earnings, and free cash flow growth and return growth. And this is telling me straight away that the market is really negative about this company over the next few years. And maybe it's not just the next few years. Maybe it's only financial year 24 that it's really negative. And if all that negative is already priced in, there is a possibility, yeah, the share price of this company could bounce a fair bit, particularly if there is light at the end of the tunnel. And I'll talk about some of the commentary this company had in the AGM, and there is a possible light at the end of the tunnel. Now let's have a look at some valuation metrics. And this is where it becomes really interesting. And this is another reason why I think the market is pricing in a lot of bad news for this company. And that's justifiable when you look at some of the comments management made at the AGM. But the PE ratio, 5.3. So again, even if earnings halve in financial year 24, you still have a PE ratio of around 10. Price to book ratio, 0.63. So this company is trading below book value right now. And the EV to free cash flow, 3.8. So that includes the debt of $113 million. And typically what I look for in value plays is an EV to free cash flow of between 6 and 10. And 3.8 is below 6. So this is one of the reasons I decided to look at this company, take a deeper look at this company, whether there is any validity to calling this a value play. And free cash flow yield. So remember, the free cash flow was 55 million. The market cap is 100 million. That means the free cash flow yield is 55%. Now, there is a lot of research that shows free cash flow yield is one of the best indications for beating market return. So free cash flow, why can't I say free cash flow yield? So free cash flow yield and revenue per share growth are two of the best indications of a company being able to beat market returns in the medium to longer term. So free cash flow yield of 55% is quite high. But again, this is an indication that the market is seeing some troubled times for this company moving forward. More than likely, those troubled times are only for the short term. Also did a reverse DCF based off the free cash flow. And to justify the current valuation, the company would have to decrease the free cash flow by 28% per year. And I think there is a possibility you might see a significant decrease in free cash flow in financial year 24, but will we see decreases in free cash flow moving forward after this particular financial year? And I don't think so. So, particularly or potentially a value play when it comes to people in just based off these valuation metrics. There is a reason why the market does not like this company right now. So let's have a look at some AGM comments made by the CEO, CFO, people like that. So, as projected in August, financial year 24 is proving to be more challenging year. Given the general reduction in business confidence and declining economic conditions, our earnings will impacted or be impacted as a result. So straight away, the management is saying profits, free cash flow, EBITDA are all going to decrease in financial year 24 unless things rapidly improve. Fun enough, they say as projected in August. I had a look at their financial results in August, and they're actually quite bullish. So a little bit more bullish than they sort of are implying right here in that first comment. Second comment, in first quarter, with many of our private clients reducing their demand, especially high margin roles, which is very important, and permanent recruiting, or delaying investment decisions. So that's very important, particularly that high margin roles. Third comment, our EBITDA for the first quarter was $10 million, which is down from the strong and robust economic conditions in the first quarter of financial year 23, where we earned $15 million EBITDA. So straight away, EBITDA in the first quarter of financial year 23 is down 33%. Now, moving on to the next three comments in the AGM, and these three comments that I found interesting or intriguing. Their revenue, or our revenue, for the first quarter was $281 million, which is an increase on the first quarter last year, where we generated $272 million, highlighting a mixed shift towards lower margin work. And that's really important. When you do any research on a company, just try to figure out what sort of margin they're getting in their work. So right now we see that there is lower margin work for this company. So even though revenue has increased, EBITDA and more than likely profit and free cash flow, operating cash flow will drop. That's because of lower margins. We expect, and this is now we get to some positive comments, we expect the wider downturn to be relatively short-lived, especially in health, and we expect higher margin demand to improve in the fourth quarter and into financial year 25. So if you believe management, things will turn around relatively soon. Now, I don't necessarily believe what management are saying because typically management of a company will be probably overly optimistic about the future of the company. So I wouldn't look at that and necessarily think things will turn around for this company within the next 6 months or so. And finally, and possibly one of the more important reasons why the share price of this company has fallen a fair bit is in regards to industrial relations reform bill that the federal government has proposed. So this comment, you could look at two ways. Federal government has proposed industrial relations reform bill. This is a complex bill that is creating unnecessary confusion in the short term. However, if passed, we believe this will create an opportunity for PeopleIN. So the management are optimistic about this reform bill. However, there is a lot of uncertainty, and the market does not like uncertainty. The market hates uncertainty, and I believe, and this is just my opinion, one of the reasons share price of this company has fallen a lot is because of this uncertainty around the industrial relations reform bill. And more than likely, just based off probability, if this industrial relations reform bill does pass through, it may not negatively affect PeopleIN all that much. And I think the market more than likely is overreacting. And that is actually one reason I have taken a trading position in this company. But there is another reason I've taken a trading position in this company, and that's simply based off the charts. So let's have a look at the charts now for this company. Yeah, so let's have a look at two charts. In this particular chart, we're looking at a weekly chart going back to when the company lists on the ASX back in late 2017. In the next chart, we're going to look at the daily chart over the past 8 months. So there are a few things I look at when I'm making a trading decision, particularly in these type of scenarios. I'm looking at support levels and pretty significant support levels. I'm also looking at volume. So when a company share price has dropped fairly rapidly, I'm looking for a ramp up in volume. That's actually a good sign that the bottom is nearing. not absolutely certainty that bottom hit has been reached, but it is usually a good sign. I'd say probably about a 60 to 70% success rate. I'm just putting numbers in my head there, but I have seen it happen a lot. Now, maybe I am looking at confirmation bias, that sort of thing, but I have seen a lot when you do see a share price rapidly fall and then you see an increase in volume. That's a good time to think about taking a position or a trading position in a company. So we have had the two things happening with this company in the past few weeks. We've seen the share price drop to a fairly significant, important support level. That support level is $1. Why is that support level fairly significant? If we go back to the COVID-19 financial panic, the share price of this company fell from around $4 all the way to $1. It briefly fell below $1 around about March 23rd, but then there was a V-shaped recovery. So $1 is the COVID-19 lows. And in fact, if you look at this weekly chart, this company was doing really well from when it listed all the way to the beginning of the COVID-19 financial panic. Share price reached a high of about $4. And then during that V-shaped recovery, the share price recovered from $1 all the way to a high of $4.88 in the middle of 2021. So a nice 1 year period for PeopleIN and its shareholders. However, since that high in the middle of 2021, the share price has been in a downtrend, and that downtrend has accelerated over the past 4 months. In fact, the share price of this company has dropped from $2.50 in July, August, all the way down to $1 as I speak. And the share price has been hovering around $1 over the past few trading days. But massive volume has come in the last 2 weeks. We've seen a really good increase in volume. Volume last week was around about 4.5 million. The volume this week, after 1 day of trading, is 4 million shares. And if we go back through the last 4 years, only once have we seen last 3 years, only once have we seen volume above 4 million shares traded in 1 week. And that was back in August of 2020. So massive volume coming in, unusually high volume coming in. And that is sometimes a good sign that we are nearing a bottom for PeopleIN's share price. Not necessarily an absolute, but a good chance that we are seeing a near bottom for PeopleIN's share price. And that is one of the reasons, in fact, the main reason I've taken a trading position in this company. And if we turn our attention, as we turn attention to the daily chart, this is the last 8 months, going back to April, we can just see that downtrend. Beautiful, defined downtrend. And that downtrend really accelerated from August when they released their financial results. I don't really remember the financial results, but the share price was around about $2.25 then. And yeah, the share price has more than halved in the last 4 months. But in the last 3 trading days, we have seen a massive increase in volume. So on would have been the Thursday and Friday of last week, the volume was around about 1.5 million shares traded. And we very rarely see 1.5 million shares traded in this company. Typically, we see less than 500,000 shares traded in 1 day. So with this increase in shares traded, that is telling me there is a ramped up interest in this company. Now, you might say, well, if there's people buying shares in this company, there's also people selling. But we're seeing a rapid turnover in shares of this company. And that rapid turnover in shares or volume has accelerated or did accelerate on Monday, the 11th of December, with 4 million shares traded. Now, in saying that, there was one cross trade after trading had finished, so this was about 4:25 p.m., where there was 2 million shares in this cross trade. So if we take away that 2 million shares traded, we still saw 2 million shares traded in this company. So really big increase in volume over the last 3 trading days. And that is telling me, just based off simple knowledge of what happens when the share price of a company decreases and you see a corresponding increase in volume, that's a good sign that there is a possibility, a pretty good possibility, that the bottom in the share price has been reached. And there might be a nice bounce in the share price soonish. So the question becomes, is PeopleIN a really good value, a deep value play, or is this a value trap? I think this all depends on what your opinion is on those headwinds. Do you think this industrial relations reform bill will significantly negatively affect PeopleIN? Do you think the headwinds the company management mentioned in the AGM will really negatively affect this company's earnings, not only in financial year 24, but also in financial year 25 and beyond? Now, I think that's very important to whether you think this is deep value or a value trap. I'm leaning towards this is really good value right now, that I think the market is overreacting. So I have taken a training position, not based off whether I think this is a good value or whether I think this is deep value, but simply because of technical signal. So I'd love to hear your opinion on PeopleIN. Do you think this is deep value or it is a value trap? Leave though your thoughts in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.